The SPDR Portfolio Short-Term Treasury ETF, SPTS, is an exchange-traded fund, ETF, that seeks to provide investment results that, before fees and expenses, correspond generally to the total return performance of the Bloomberg Barclays U.S. 1 to 3 Year Treasury Bond Index. The ETF is designed for investors who are looking for a way to gain exposure to the short-term U.S. Treasury bond market. By investing in the ETF, investors are able to gain exposure to a diversified portfolio of short-term Treasury bonds with a single investment, which can help to reduce risk. The ETF is managed by State Street Global Advisors, one of the largest and most experienced asset managers in the world. The fund is diversified across a range of short-term Treasury bonds, with the goal of providing a balance between yield and stability. The ETF has a very low expense ratio of 0.04% and has an AUM of $900 million, which is considered very big. One of the main advantages of investing in the SPTS ETF is that it offers a relatively low level of risk compared to other types of bond investments. Short-term Treasury bonds are considered to be among the safest types of bonds, as they are issued by the U.S. government and are backed by the full faith and credit of the United States. This means that the risk of default is very low. In terms of yield, the SPTS ETF provides a modest but steady stream of income. The yield on the ETF will fluctuate based on changes in interest rates, but it is generally considered to be a relatively stable income source. Another advantage of investing in the SPTS ETF is that it is highly liquid. As an ETF, it can be bought and sold on a stock exchange, just like a stock. This means that investors can easily and quickly buy and sell shares of the ETF in response to changing market conditions or to meet their investment goals. However, there are also some potential downsides to investing in the SPTS ETF. The fund is exposed to the interest rate risk, which is the risk that bond prices will fall as interest rates rise. This can happen when the Federal Reserve raises interest rates or when bond yields move higher in the market, causing bond prices to fall. Additionally, the fund is highly dependent on the performance of the U.S. economy, which is inherently risky, as the fund is exposed to the U.S. government bond market. In case of a recession or significant economic downturn, the value of the ETF might drop or the interest yield might decrease. In conclusion, the SPDR Portfolio Short-Term Treasury ETF, SPTS, is a low-risk investment option for investors who are looking for a way to gain exposure to the short-term U.S. Treasury bond market. The ETF provides a diversified portfolio of short-term Treasury bonds, a steady stream of income, and high liquidity. However, investors should be aware of the potential downside risk of interest rate risk and economic downturn risk. As with any investment, it is important to consider an individual's investment goals, risk tolerance, and financial situation before investing in the SPTS ETF or any other investment.